Modern professional life had become quiet, fragmented, and isolating. Traditional corporate towers served a different era, vast, sterile environments where workers operated in silos, entirely disconnected from the people around them. A rising class of freelancers and early-stage startups required something else. They required flexible lease terms, but deeper than that, they craved legitimacy. They wanted a physical space that signaled success before they had fully achieved it, and a community that made the daily grind feel less lonely. WeWork arrived with a highly polished answer. They took mundane commercial real estate and transformed it into a lifestyle brand. The spaces were curated with warm wood, neon signage, and communal tables, looking less like a place to process spreadsheets and more like a high-end social club. By diagnosing and curing this psychological pain point, the company grew rapidly. They successfully made the boring logistics of renting a desk feel like gaining entry into a powerful, inevitable movement. Leading that movement was Adam Neumann. He explicitly rejected the title of landlord. Instead, he presented WeWork as a tech-enabled revolution, speaking openly about using the platform to elevate global consciousness. That sweeping narrative created a powerful halo effect. In a market hungry for disruption, venture capitalists stopped looking at WeWork as a property manager and began evaluating it as a limitless software platform capable of infinite scale. The media attention and investor frenzy compounded, eventually pushing the company's private valuation to $47 billion. But that number was a trap. To justify a $47 billion price tag, WeWork could never admit it was a traditional real estate business. It was forced to constantly maintain an illusion of unstoppable, exponential growth. Behind the glass walls and the community rhetoric, the company's economic engine relied on the Bouville's structural mismatch. This diagram illustrates the trap. On one side, WeWork locked itself into immovable, heavy obligations, signing commercial leases spanning 10 to 15 years. On the other side, it financed those obligations using a fragile pile of short-term 30-day member contracts that could be canceled at any time. With rigid liabilities outweighing flexible income, the cash burn rate accelerates downward. To hide the deficit, the company had to keep opening new locations, using fresh capital to pay for old mistakes, and expanding recklessly just to keep the momentum going. That constant need for cash was met by SoftBank and its Vision Fund. They poured billions of dollars into the operation, supplying the fuel that kept the expansion loop spinning. When capital is that abundant, standard corporate oversight often disappears. The massive influx of funding effectively silenced internal critics and gave Neumann near absolute control over the board and the company's direction. The operation had transitioned into a machine designed specifically to consume venture capital and project global dominance, regardless of real estate fundamentals. Eventually, the private markets could no longer sustain the cash burn. WeWork needed to go public to secure more funds, leading them straight to the New York Stock Exchange and the required S-1 prospectus filing. That filing stripped away the lifestyle marketing. For the first time, Wall Street analysts looked past the polished lobbies and examined the actual financial architecture holding the company together. This breakdown of the S-1 reveals exactly what they found. The document exposed billions in operating losses, highly unusual related party transactions, and a governance structure that granted the founder absolute voting authority over all decisions. The market reacted with immediate whiplash as investors recognized the company's true identity, a dangerously over-leveraged real estate firm masquerading as a high-margin software empire. The prospectus forced a collision. The emotional language of belief crashed headfirst into the unforgiving reality of financial accountability. The unraveling happened with breathtaking speed. Within weeks, the IPO was pulled, the $47 billion valuation evaporated, and financial panic consumed the operation as the fallout played out across financial news networks. Under intense pressure, the board orchestrated a coup to oust Adam Neumann. The visionary founder, once treated as the company's greatest asset, had officially become its most toxic liability. While most businesses fail due to market shifts or poor timing, WeWork represents a different phenomenon. Its collapse resulted from a manufactured narrative being allowed to completely outgrow its structural foundation. It leaves behind a severe lesson for modern capitalism. There is a deep psychological danger in mistaking venture capital applause and aggressive branding for a durable, tested business model. Charisma cannot balance a ledger. When style is willfully mistaken for substance, collapse does not arrive as a surprise, it arrives as an invoice.